Hello everyone and welcome back to the channel. Today, we take a deep analytical look at how trade agreements and sanctions have influenced the Russian economy during Vladimir Putin's presidency. This video is not political propaganda, nor is it an attempt to argue or justify actions. Instead, we focus entirely on data-driven insights, official statistics, international reports, trade figures, and long-term economic indicators. Our goal is to understand what the numbers actually say, separating measurable effects from speculation or opinion. By the end of this video, you'll have a clearer picture of 1. How Russia's trade model functioned before 2022, 2. The design and objectives of sanctions introduced after 2022, 3. The real economic and social impact of these measures, and 4. How Russia adapted its trade and financial policies and what this might mean for the future. So, let's dive in. Before 2022, Russia held a significant role in global trade, primarily as an exporter of energy. Oil, natural gas, and petroleum products accounted for a large portion of export revenues and government income, often exceeding 40 to 45% of total federal budget revenue. The European Union was Russia's main trading partner, especially in energy, and this relationship ensured stable foreign currency inflows. Other important partners included China, Turkey, and several CIS countries, but Europe remained the central pillar of Russia's energy-based fiscal system. However, this reliance on energy exports created a structural vulnerability. When external pressures targeted trade or finance, the Russian economy had limited buffers to absorb shocks. Even before 2022, analysts warned that high dependence on hydrocarbon revenues made Russia highly sensitive to fluctuations in global oil and gas prices, as well as geopolitical tensions. Understanding this baseline is crucial to evaluating the impact of sanctions introduced later. At the same time, Russia maintained a diversified trade network, exporting metals, chemicals, machinery, and agricultural products. Yet, the revenues from these sectors could not fully offset fluctuations in energy income, meaning the economy's stability was heavily tied to energy demand and global prices. To structure our analysis, we focus on 4 key questions. 1. How effective were sanctions in weakening Russia's trade and financial systems? 2. Did Russia manage to compensate for lost markets through new agreements and partners? 3. What were the measurable economic and social consequences of these policies? And 4. How sustainable is Russia's current economic model moving forward? Throughout this video, we will examine each of these questions step by step using verified statistics and public data. By the end, we will synthesize all findings into a clear AI-driven conclusion, providing a structured, comprehensive understanding without speculation or bias. Sanctions introduced after 2022 were unprecedented in scope and depth. Key features included freezing significant Russian foreign currency reserves, in some cases over $300 billion held abroad, restricting access to international financial systems, including the SWIFT payment network, imposing strict trade bans on technology, energy equipment, luxury goods, and defense-related products, and applying secondary sanctions targeting global partners who continued business with Russia. Unlike simple trade restrictions, these measures were designed for cumulative effect, intending to gradually weaken Russia's financial and trade capacity over months and years, rather than through an immediate economic collapse. They were carefully structured to impact multiple layers of the economy simultaneously, from banking and trade to logistics and investment. Financial sanctions in particular created short-term instability. Banks faced limitations on international operations, and capital flows were tightly controlled. In response, the Russian central bank implemented strict capital controls, raised interest rates to stabilize the ruble, and regulated foreign currency movements. These measures stabilized the system and prevented a total financial collapse, but simultaneously increased the role of the state in everyday economic activity. For businesses and citizens, this meant limited access to foreign currency and a more controlled domestic market.
Energy exports were at the center of the sanctions strategy. Key actions included limiting oil and gas exports to Western countries, introducing a price cap for Russian energy products coordinated through international coalitions, and disrupting contracts with traditional European partners, some of which had to abruptly seek alternative suppliers. Russia responded by redirecting energy exports toward Asia, mainly China and India. While physical export volumes largely remained, the unit revenue decreased due to discounts necessary to secure new buyers and the costs of rerouted shipping. Analysts estimate that while Russia maintained roughly 80 to 90% of pre-sanctions export volumes, the revenue per barrel was reduced by 20 to 30% in some markets, illustrating the difference between quantity and financial gain. This adaptation highlights an important point. Quantities exported do not equal economic gains. Even with high volumes, lower prices, logistical challenges, and contractual renegotiations affected overall budget revenues and economic planning. Moreover, transitioning to new trade partners required changes in payment mechanisms, often involving national currencies instead of US dollars or euros, which added layers of complexity and risk. Russia actively negotiated new trade agreements and shifted financial settlements to national currencies. These steps partially compensated for losses in Western markets. Agreements with China, India, Turkey, and other partners allowed Russia to maintain energy and commodity flows, but this adaptation introduced challenges. Higher logistical costs, including longer shipping routes and port handling fees. Dependence on a limited number of partners, increasing geopolitical and economic risk. Reduced diversification, making the economy more vulnerable to regional disruptions or partner-specific policy changes. Domestically, the government increased spending, supported critical industries, and promoted parallel imports to mitigate shocks from sanctions. While these measures stabilized short-term economic activity and prevented immediate social disruption, they reduced market transparency, limited foreign investment, and constrained long-term competitiveness. Investments in high-tech sectors and innovation slowed, potentially creating long-term structural challenges for economic growth. Social sentiment is complex. Polls indicate a relatively stable level of support for the government, but data interpretation must be cautious. The methodology of surveys, phrasing of questions, and influence of state-controlled or social media framing heavily affect reported outcomes. Online discussions reflect polarized opinions, showing high levels of debate and disagreement. These forums provide insights into perception trends, but cannot replace formal economic or social indicators. The divergence between perception and measurable data highlights how narratives can diverge from factual outcomes. When comparing the stated goals of sanctions to measurable outcomes, immediate economic collapse did not occur. Investment inflows and foreign capital declined significantly, limiting expansion and modernization opportunities. Trade structures shifted toward Asia and other non-Western partners with reduced diversification, and the economy became more state-driven and less transparent, with growing government intervention in strategic sectors. The effects are gradual and cumulative, not instant. While short-term stability was maintained, the long-term sustainability of this economic model remains an open question, requiring continued independent evaluation. Thank you for watching. All sources are publicly available for verification, and diverse perspectives are welcome.